Welcome to Roaming Returns, a podcast about generating a passive income with dividend stocks so you can secure your finances and liberate your life.
This week, we're talking about what might be the single most important pillar of everything we do here, the Income First retirement portfolio. This is the strategy where your retirement account is built to pay you first, through dividends and interest, so you're not forced to sell shares just to live. Growth still matters, but it's secondary. The priority is predictable cash flow, protecting principal, and avoiding one of the biggest retirement risks there is, selling assets during a market downturn. In this episode, we break down what an income-first strategy actually is, how it differs from the traditional total return approach, the assets that typically make it work, the risks people overlook, and how we personally structure portfolios so income funds life while growth compounds quietly in the background. If you've ever wondered whether retirement has to mean slowly liquidating your portfolio, or if it can function more like a paycheck, this episode's for you.
So we're back. Last week, what did we talk about last week? Oh, new 2025 statistics.
Statistics on,
Yeah, expenditures and whatnot, yeah.
Yep, versus what you're incoming.
So this week is going to be something super exciting that you guys all should know.
Oh, yeah? What is that?
Basically, the Income First retirement strategy. Like, it's the pillar of everything that we kind of do and talk about and everything. Like, basically, in a nutshell, Income First is you get paid first before your stuff compounds.
Okay.
So it's something that I'm fairly passionate about because I think that a lot of people...
What do you mean by compounding?
Miss the point. Like,
you mean like growth stuff?
If you're in a retirement account and you're retired, you want income first. You don't want your stuff compounding.
You want both.
Well, ideally, but like if you have to pick either growth or income, you're going to go with income.
But you're going to prioritize income first, yes. Okay.
I do believe it's super strong for a retirement account or those people around the retirement age because they need to have their bills paid so they can do what they want to do. Whereas if you're in your 20s or 30s, you can do the growth or you can do a hybrid between growth and income, whichever.
Tickles your fancy.
Basically, you're prioritizing earning income from interest and dividends with growth and appreciation secondary. So, like, it's not like you're completely ignoring growth and appreciation, but that's not your primary concern.
That was why I asked that question.
So that differs from the traditional total return approach that relies on where you sell shares, where you dip into your principal to generate cash flow, like you do your growth thing, and then you sell shares to for whatever you need for that month.
AKA the 4% rule.
Like, that's what I'm a firm believer. Like, I would rather have just a paycheck coming in every week or month or every 3 months, depending on what the stock is, as opposed to having to sell shares to pay for it. But So we're going to explain the income first strategy a little bit. The approach is basically you construct a portfolio that provides you a steady, predictable cash flow to cover your living expenses without being forced to sell assets during market downturns or even market upswings, whichever. You do this because it helps protect the portfolio's principal from a major risk. And we did this years ago in her mother's retirement account where I needed money for something and I had to sell shares, and you kind of do it all the time where you're selling, like if you have a fixed amount of money in your account and you're not generating any cash, you have to sell shares. This is before I established the retirement account.
I call that the capital churn.
Where it actually gave us income every month. Like, this is back before then. It was literally just all growth stocks. And when I wanted to get into another growth stock, I actually had to liquidate shares of a previous growth stock to pay for it.
Yeah, and the reason we would choose to do that is because we would get more output from the other one than the one we currently were in. And because there was only so much capital to allocate, you have to actually maneuver it or move it from one to the other.
I think the biggest, probably the biggest thing about the income first retirement that is not really addressed too well in the readings is what I just said. Like, if you need income, but the markets are down, you're going to have to liquidate your shares of your growth portfolio at a lower price so that you can afford whatever expenses you need to pay with your portfolio.
But if you have dividend stocks,
we want to avoid that entirely. I never want to actually be forced to sell something for income.
Right, because that's one of the biggest ways.
That's when emotion can creep in because you're not supposed to be emotional. But if you have a bill for $2,000 due and you don't have $2,000, you're going to liquidate $2,000 in your portfolio. And if it's in a market downturn, it's more than $2,000 because you have all the upside after the market turns around that you're missing out on.
You're missing out on a lot because it's lost gains, lost potential, and that really, really sucks.
Okay, so the main goal of the Income First retirement strategy is to live off the natural income streams, interest and dividends, generated by the portfolio without needing to liquidate assets. Like we've covered that pretty good. Now there's a risk mitigation factor that it's like basically inherently a part of the income first strategy, and that is when you generate income internally, retirees or people that you don't necessarily have to be a retiree. Anybody are better protected against market volatility and the danger of cannibalizing their principal.
Ooh, I like that.
By selling shares for income during a down market. And that pertains to everybody. But because it's a income first retirement strategy, most of the readings kind of discuss it as it pertains to retirees, not just investors. If you have dividend growth stocks and dividends that have a consistent payout, then it's highly predictable. The strategy offers more predictable cash flow because you know exactly what you're going to get when you're going to get it, because you have a dividend growth stock and you have quarterly payers that have a good dividend history, or monthly payers that have a good dividend history. You know exactly what you're going to get each month. And that's super helpful whenever you're trying to pay bills when you're retired, because your bills come through and you're like, I need $3,000 for this. Well, you know you're going to make X in whatever stock that'll go towards the 3,000.
Right.
So that will actually reduce your worry about market swings
or how long you're going to live, or a whole bunch of other.
That's the one that like none of the readings actually touch that. For whatever reason, like if you do the income first approach, it's actually more sustainable for a longer life span.
And because nobody really knows how long they're going to live, that's a big one that I think people don't realize is driving a lot of their fear. And the fact that we don't know about prices or interest rates or inflation.
I think that they're starting to like come around, because I see a lot more people say maybe you should be in dividend stocks whenever you're retired. And I think they're starting to see that it used to be if you retired at 65, you lived to 72. So it was only a 7 or 8 or maybe 15 years,
right.
The best case scenario, 15 years that you had to
live. But with advancements in technology and health, and now you're adding the AI.
If you're retiring at 62, you could live a full, like my grandpa retired at 62, he lived to 95. So that was 30, that was 33 years. And like his retirement wasn't set up to have 33 years worth of payments.
Right. And that's actually one of the reasons why pensions are going by the wayside, because like companies cannot take that burden on. That's actually, I think, why the 401ks and the IRAs even came about in the first place.
Now, one area where you have to make sure that you're paying attention to and you're not doing it is whenever you stretch for yield, because you know what money you're going to need in your monthly bills are going to be when you're retired. You'll actually stretch for higher yielding investments that'll actually cover that. We may not be the best ones to talk about not stretching for yield, because we have all sorts of, it's about half and half. Like we have like half of it in like sustainable quality dividend growth stocks, but then we have probably
we're not completely YOLO.
40% of our portfolio in just crazy shit.
We do, yes.
But like there's a method to the madness. If you actually look at the portfolios, you'll see that like the income producing stocks are the crazy ones, and that's just what we're going to live off of. And then the stuff that we're going to rely on 10, 15, 20 years down the road is all the good dividend growth stocks.
So we tried to hybridize a strategy by having both kind of early.
Yes, I've been perfecting that.
Yep. So that's kind of like an experiment. We're living an experiment, and if we fail, we will figure something else out.
So the I think the primary challenge though is not so much the stretching for yield, like the reading said. It's about having a lifestyle that's conducive to whatever your natural income stream is from your dividends.
The aligned income.
That's the challenge.
Expenses.
So if you have quality investments and you're only making $2,000 a month, you're going to need to like redo your life so that you're only spending $2,000 a month. That way, it won't become a problem.
Figure out how to actually get that up.
Now, one thing that I wasn't actually able to figure out is how much people make in Social Security. So, like Social Security, if you're retired, Social Security will actually obviously will add
offset
to
something,
add to your income.
I think the values have actually gone up from what my mom was telling me that she gets, because I think her payments were like $1,500, and that all also depends on when you decide to start drawing on that. You get less money if you're at whatever 65 age versus 70 or whatever the heck the numbers are. In 70, you get a bigger payment, but they do that on purpose because most people don't make it to 70 for them to pay that out.
No, I'm not saying that the income first is better than the growth, the growth approach, the total return approach. I'm just saying what works better for us and probably countless other people is having the income every month. There is plenty of evidence where the total return approach could generate higher overall return over time if the market performs super well like the last 20 years.
The
So
problem,
even after you sold shares, you still have more in your brokerage account because the market just went up like 100% in the last 4 or 5 years.
right, but that is more like chance and odds, because if you have to retire and start drawing on that the year that the markets implode or the first 3 years, it dramatically reduces your monthly ability to actually have, because if you're using that 4% rule that everybody talks about when you go that route, like I think there's a lot more uncertainty with that route. And if you're okay with that, that's fine. But if you're afraid of that, which a lot of people I think are and don't realize they are, the dividend and the income first aspect solves a lot of those uncertainty
Well, neither one of them are
problems.
100% fail proof.
Right. They aren't, but I think there's less issues or less like
So they both have
subconscious worries if you go the income dividend.
But that's why
aspect
when I
first.
said like quality investments, like if you invest in Coke, for example, Coke's not going anywhere in the next 30 years,
Right.
no
And if you-
matter what happens.
If you look back at that episode that we did where we talked about what happened with, what was it, $1,000? $10,000 invested over the 30 years in Coke. Insane
Yeah, it was-
compounding.
It was like $1 million.
It was, I think, more than $1 million.
Altaria was like $2 million, and Walmart was like $2.3 million with $10,000. So like
Trio was like 4, wasn't it? It was
Wait,
some crazy numbers.
with
Go back and
Altaria
listen to that
itself was like
episode.
$2 million, but then you had an extra
The spinoffs.
extra 1 point some million from 2 spinoffs.
Right, 2 spinoffs and things. So
that's why like what I've been kind of doing with the portfolios in the last 12 to 14 months is I've been actually, the first part of the portfolio build was I built up like income generating things where I had money in my account every month, whether it be like XYLD, JEPQ, even if it's the Round Hills, whatever the case may be, whatever ETFs or closed-ended funds I was using, I always had money in my retirement account and the van life account that I, at the end of the month, I could say, well, this one's looking pretty good. So once I actually established the income stream to my liking, then I actually started using the money and dumping it into like Altaria, dumping it into like Bristol Myers, stuff like that. So I started putting it into really good stuff that I know is going to be around 30 or 40
dividend
years.
growers. Mm-hmm.
The reason I did that is twofold. Like
Stability and
the first
security.
fold was that we had income every month. If we had a unforeseen thing that we needed to pay for, we actually had income in the brokerage account that we could have pulled out and paid for it. The second is that second thing is we have stuff that's going to be around forever.
Mm-hmm.
Plus, we actually will have these income streams. If they may go to zero, they may not. Who knows?
And the thing with the dividend growers, like that yield actually goes up over time. So the more time you give them to do that, the higher your yield actually is. So they become the riskier, they take the place of the riskier ones in the beginning is kind of what that ends up happening.
Okay, so now the portfolio, whenever you're setting up an income first portfolio, you're going to have a diverse mix of a few of the things that we're going to go over here. These are the different type of investments that are in income first portfolios. The first we've mentioned multiple times now, dividend paying stocks, because they actually provide a regular income stream. They're easy to research. You can tell, hey, this company can afford its dividends, so the dividends should be there for the next 12 months at the
Very least.
at the least. And all the dividend growers have potential for dividend growth, which is awesome because the dividend growth that they're throwing off actually is a natural way for you to combat inflation. Without having to worry about combating inflation.
Right. It's a direct way or a passive way to deal with that.
The second one we've actually mentioned multiple times is the corporate and municipal bonds. They're steady, predictable interest payments. The municipal bonds actually have the tax advantages. If you, for example, we were doing the live stream last night when we were scrolling through looking at stuff, I did see that like we currently are in Pennsylvania, and there is a BlackRock that has Pennsylvania bonds for like 7.6%. If you live in Pennsylvania and you got the BlackRock Pennsylvania bond, you're not paying any state tax on the Pennsylvania bond.
Municipal. It has to be municipal though.
Yeah. So they do have tax advantages on the muni
and that's
bonds.
Key if you're in a non-retirement account like we are, because we're planning to tap our actual income before retirement age without penalty. If you're in a retirement advantage account, aka a 401k or IRA, whatever, or SEPs, a whole bunch of other crap they have, those do not really matter because they're already tax advantaged. So that just doesn't even really.
I can tell you through the years, like if you do this more than like say 6 months to 6 to 12 months, and if you do this 2 years, 4 years, whatever, you will innately discover all these investments, and you'll actually learn how to evaluate them and how to invest in the better ones. It's just like I learned on the go how to do all this.
Right.
And like
the fastest way to really learn something is to start actually applying it, using it, exposing yourself to it, immersing.
Because I know
Immersion.
bonds are like, I know corporate bonds are something that people get like nervous about because they have the par value of 1,000, which is sometimes confusing.
It definitely
But like
is.
once you dabble in them a couple times, you understand that you want anything under 1,000, and then you get the interest plus the appreciation back up to 1,000. So
Right. Then you have the rating, and then you have like a couple trade-off things. What the
because
heck are happening with the interest rates?
currently we have in the Vanguard retirement account, we have 3 bonds. We have a First Energy bond that's like $30, so that's potential for 70% price appreciation. Plus, you're getting a 10% interest payment every month or every year, 2 payments. And then we have an Alteria one that is currently like $81, so we still have 19% appreciation in that. And then we have a Milan Pharmaceutical one that's at 82, so we have 18% appreciation on that. So like once you actually start dabbling in the bonds, I wouldn't recommend using Vanguard because it's a really it sucks
It's
compared to
cumbersome.
it sucks compared to Schwab. I mean, that's one of the reasons I really like Schwab is because when I go into bonds, I know exactly what I'm looking at as opposed to Vanguard. It's like,
Right.
maybe.
Vanguard is mainly for people doing the Vanguard index funds.
No, there's nothing wrong with index funds. Like
Right.
I'm like
Vanguard's perfect if that's
we've
the
said
route you're
this
going.
numerous times. Like it's just not my jam. I just don't like them. I don't like you're basically too reliant on fund managers to do the work for you, and
Well,
like not all fund managers are.
Well, that's more of the active funds. Index funds are like passive where it's whole market.
Well,
but the problem with that is
there are active index
but you have
funds.
the 10 stocks that basically are holding the market up. And I think that's more of a
Because I would never invest in a
risk.
passive index fund because that's literally just a computer algorithm, and the computer gets it wrong more often than I think people know. Anyway, the third investment in these income first strategy retirement accounts is real estate investment trust REITs. Like we've been over these ad nauseum through the years. Like
I love REITs.
they're set up specifically so they have to pay out 90% of their gross profits in the form of dividends or interest. So like their payment rates, their yields are generally like 6 to 7% would be a really good one.
And they're a great alternative for people who don't want to actively manage real estate themselves.
The fourth primary investment in an income first retirement account would be annuities. I'm not a fan of those. I would never say get annuities, but some people.
If you are interested
them.
in annuities, I highly recommend reading Tony Robbins' book, Money Master the Game. He covers a chapter after interviewing experts on the annuities concept, and not all annuities are created equal. A lot of them are scams. So if you are interested in those, definitely go read that section of that book, and he explains like where
Basically,
to figure out what's
in
what.
a nutshell, aren't they just like a pension?
Kind of. What you do is you feed them money, and they do what we do. They put them in higher yield investments, and then they're supposed to pay back. Like you're supposed to essentially get those dividend payments from the annuity. And if they're set up properly, they will literally pay you for life. The scammy ones are the ones that go down because they're investing in like not what they're supposed to be. And you don't end up getting like your full payout in, out, plus anything. Like they're just.
I'd rather do the work myself.
Right. So they're kind of essentially doing the same thing you're doing if you just set up your own dividend growth portfolio.
The next
without fees and without
primary
other
vehicle
stuff.
would be preferred stocks. We've covered those before. They're a hybrid between stocks and bonds. Basically, preferreds have a par value, generally $25, although there are $50 or they're $10 or $100, but generally it's $25. So they're very easy to like, okay, well, this one's undervalued. Like the par value is 25. It's trading for 20, so it's undervalued. And with a preferred stock, you get generally four, although there are some monthly payers, but you'll get 4 fixed dividends.
Right. So the cool thing about these is they're a lot cheaper than bonds. So you get more shares, and then you can actually pick the companies.
I think any income account portfolio should have preferred stocks.
Mm-hmm.
And if you're lazy, you could actually just look at like a PFFA, which is a preferred stock closed-ended fund.
There you go.
They just pick them all up for you, and you get a monthly dividend.
See, if you can think of anything you're trying to find, you can always find a fund or something that does it for you.
The next is
quite nice.
bond ladders. I've actually never done this, but like this is where you stagger your bonds.
You have to kind of done it.
No, I just buy bonds. I don't care.
Well, maybe not with bonds, but you've done it. You do it with the actual dividend payouts that work. Since now everything's trending towards monthly and weekly now, which is kind of ridiculous. The quarterly ones, if you actually go back to our earlier episodes, we were actually staggering to try to create like equal quarterly payouts.
Well, that's just because I'm OCD. I don't like when like one.
I don't like making the decision on a good stock versus a not as good stock just to have an equal portion thing. So I do like the monthly ones better for that reason.
But
plus you have
basically,
the compound
what a
factor.
bond ladder is you would actually have 12 bonds, and every bond
Wouldn't
that
it
you
be
would have,
6?
oh yeah, with 6 bonds with 2 payouts a year, and you'd have a bond that pays out in January and July, and then you'd have another bond that would pay out in February and August. So like you're getting a payment every
month. But we have 6 different vehicles to get your full year for each month.
And if you've ever tried
That's
to
what a
like
ladder is.
research bonds,
It's a pain.
It's exhausting.
And it's so hard to actually set that up.
That's why
So,
PDI is my preferred. Like again, that's
Monthly.
a bond, a closed-ended fund that pays you monthly. It's 22 cents per share per month.
Isn't DSU one too?
DSU is one, yes.
I think we just analyzed that one last night.
Oh.
And that one was overvalued?
It was about fair value.
Fair value? I can't remember.
But I just didn't like the price of it. Now you can get it cheaper.
Okay.
And the last one in a income first portfolio we've mentioned like 4 times now is a closed-ended fund. Like, these are a type of they're a lot like ETFs, except the difference is ETFs can generate more shares, whereas closed-ended funds, for the most part, they have a fixed number.
So they have
of
a
shares.
scarcity aspect locked in, which is actually really good.
Now they wiggle around that by offering new shares whenever they present it to the shareholders, and then the shareholders vote on it and say, yeah, let's put like another 15 million shares in the market or something like that. But they don't just arbitrarily add more shares.
Right. And if you look at crypto, that's a really good example where Bitcoin is one that is basically built on scarcity. So that's why the value of Bitcoin is so high. Same thing with gold. A lot of the other crappy cryptos, like if you look at the underlying, like how they work, most of them just like generate random numbers of shares. Like that's why some of those staking things that are really high go to zero. It's because they're constantly pumping out shares, which is diluting value, and it just creates this essential like go to zero motion. So that's what's nice about closed-ended funds versus the open funds.
So those are the vehicles that you can invest in. I mean, yes, you can do ETFs too if you want. The ETFs, like there's plenty of ETFs out there that you get monthly payments, like JEPQ is one that gives you. But the problem with most of the ETFs that I've encountered, I'm not saying it's all of them, but the ones I've encountered is they're variable. Like JEPQ's dividend is variable. So like if you're retired and you need a fixed income, you can't rely on a variable dividend or
you make sure you have your base locked in, and then whatever's above that is extra. I should have actually used the high yield, like YieldMax and those as the comparison instead of like the crypto ones, because those do like completely have that share dilution issue, which is what causes those reverse stock splits all the time. So it's probably a better analogy.
But like but going back to the ETFs, like some of the best ones, XYLD, variable income, JEPQ, variable dividend. Well, RYLD is a variable dividend. QYLD is a variable, like say, so generally like the ones that you're looking for will have a variable monthly dividend. Now there's ways around that. You can kind of ascertain what the median payment is.
Mm-hmm.
If you just take like the 12 months previous and you add them all together, then divide by 12, you can come up with like a ballpark figure of what you should be getting. And that's also a good thing if you actually hold those, because if you go back and you see that for the last 12 months, your dividend's been averaging, say 45 cents. And then like for the next couple of months, it's at like 30 cents. Well, that's a huge red flag.
Right.
Why is my dividend so much less than what it's been the last 12 months?
Right. It's
on average?
downtrending. Red flag.
So that's good. If you don't keep a spreadsheet like some of the nerds.
There's a lot of information you can gather on like early red flags with your stocks if you do.
Okay, so let's look at some of the key differences between the total return strategy and the income first strategy. Income first strategy, like we've said numerous times now, relies solely on interest and dividends generated by investments, where the total return strategy combines interest, dividends, and capital gains, selling shares to meet income needs. So that's the huge difference in the way they get their income. The principal management income first strategy aims to protect the original principal. What that means is like if you invest $100,000, you basically the $100,000, if you do it correctly, your principal amount should be around $100,000 for the duration of your retirement. You're basically living entirely off the earnings. The idea of, quote, not eating your principal.
I love the cannibalization term. I love it.
Whereas the total return strategy, there are certain rules, like where you're systematically selling a set percentage of your portfolio, basically the 4% rule, which involves drawing down the principal over time.
Yep.
So you're hoping that your principal over time stays about $100,000, even though you have a lot less shares. Again, that's hope. Whereas the income first is not really hope; it's
more
there.
Yeah.
Oh, okay.
And as you've seen with the last couple years with Trump being president, like the markets have been so all over the place. Like, that's why I said if you're waiting to retire on that growth return strategy 30 years from now, who the hell knows what the freaking state of the market's actually going to be like?
So that's what we're going to talk about, market volatility. With the income first strategy, you basically have no worries about market swings as the focus. Your focus is on stable, consistent income streams, high quality dividend stocks, rather than your portfolio balance. That helps you immensely when it becomes like a lot of people get emotional and they sell assets in a down market.
Or even just seeing your value go down. If you're always focused on value, you'd be freaking out every time the market dips, which I'm assuming why most people freak out when the markets dip.
Whereas the total market strategy, total return strategy, you're more vulnerable to sequences of market risk, a market downturn. Basically, if there's a market downturn in the first couple of years of your retirement and you have forced to sell your assets at a loss, you've basically exponentially increased your risk of running out of money in retirement, unless you can add more to it somehow.
Right.
It's the whole, like, it's basically the compounding in reverse. If you have 100,000, you're forced to sell 40,000 of it. You have 60,000 that you're banking on to fulfill you the rest of your retirement. And like, there's a high chance you'll run out of money because you're going to have to sell off shares at some point, potentially. The investment focus for these two strategies, income first strategy, they prioritize assets that generate high predictable income, dividend stocks, bonds, REITs, closed-ended funds, the stuff we already mentioned. Whereas the total return strategy focuses on a broad, diversified mix of assets for maximum growth potential, regardless of their income production. It's literally like growth stocks versus dividend stocks.
I thought we used a total return strategy. Is that a total return strategy with dividends?
Total return,
because I thought
what we do is like the total return whenever you're calculating it is when you take your total number of shares times the share price, then you add back in your dividends. That's your total return,
right? And that's a different actual, even though it's the same name as the strategy they're talking about here.
Total return strategy is different. Okay. It's a different.
So I kind of wanted to put that out there because, again, if you have the same name for something, it's a different concept. You can get confused very, very easily. I would have labeled the total return strategy for this more of the growth focused, but
I'm just doing.
I know. I'm assuming this is like
what the reading say.
This is what it calls it.
Okay, and the income first strategy, your control of distributions. You basically, your income stream fluctuates with prevailing interest rates and dividend payouts, meaning you have literally zero control over the exact amount of cash flow unless you're willing to sell certain dividend payers and put it into other ones, which we do a lot. If you're subscribed to email, you'll say like, well, I'm out of this one because it cut its dividend, or I didn't like the earnings report and we took the cash and put it in this one. So you have some control, but it's like you have zero control over like the actual payments from the companies. Okay, where the total return strategy, basically you have more control over the amount and the timing of your distributions because you can strategically sell shares, which, if you're worried about taxes, you can actually make it more tax efficient in certain accounts and certain times at certain times of the year. Like you control a lot of the aspects of a total return strategy, a portfolio, as opposed to income. So again, income first is designed for predictable and peace of mind by creating a regular paycheck. That's like very few people actually call it what it is. You're basically creating your paycheck in retirement through organic earnings. While the total return strategy is built around maximizing your overall portfolio value and strategically liquidating assets as needed. So we'll give you a couple of examples of the different investment vehicles that we have currently in our portfolio. Dividend growers, we have ES, which is a 26-year dividend growth streak, which has a 5-year average growth rate of 6%. So that's above inflation. We have SON, which we just picked up recently. It has a 43-year dividend streak with a 5-year average growth of 4%, which I think is about what inflation is. And then we just picked up HTO, which has a 58-year streak and a 5-year average growth rate of 5.5. We've held MO Alteria forever, and it has 56-year growth streak with a 5-year average growth of 4%. And we just picked up KMB, which has a 54-year streak with a 5-year average growth rate of 3.5. So those specifically were picked up because they're dividend growers, and we got them at a good valuation price. And then we're just that like how people do the set it and forget it with the index funds. That's kind of what my philosophy is going to be with the dividend growth stocks. Just you get them at a good price and just let them do what they're going to do for as long as.
And you turn drip on for these until you tap them.
Yeah. ETFs and CEFs. closed-ended funds, we have SBAR, which is it gives you a 10% monthly payment of 28 cents per share. We have THTA, which gives you a 12% yield with a monthly payment of 15 cents per share. We have JEPQ, which gives you a 10% yield with a monthly payment on average of the last 12 months of 50 cents per share. We have NBXG, which is a 10% yield with a monthly payment of 12 cents per year. And we have PDI, which is a 14% yield with a monthly payment of 22 cents per share. And the last one, like the last example, is SRV, which has a 13% yield and gives you a monthly payment of 45 cents per share.
I think you said 12 cents per year, not
Do you,
per
do you
share.
see how, like, even though these are ETFs and closed-ended funds, but like you can see the consistency there. Okay, 28 cents a month. You know exactly what you're going to get based on your share count. If you drip it or not, it doesn't matter. If you drip it, you just basically take your drip, add it to your current shares, and take that times 28. So you're going to be able to have a consistent idea of what you're making.
Right.
That is what you do with the ETFs and closed-ended funds. You have a blueprint exactly what you're making with those investments. Now, we do have some income producers. These are the ones that are the paychecks. They're ETFs. We have the Palantir one, PLTW, which has 100% yield, which has paid $1.41 in dividends so far in 2026. We have WPay, which is a 42% yield that's paid $1.38 in dividends per share in 2026. We have ULTI, which is a 75% yield, which has paid 98 cents in dividends per share in 2026. One of our newer ones is NUGY, which is a 100% yield, and it has paid $1.76 in dividends per share in 2026. The newest one there is SEMY, which is a 125% yield, which has paid $2.21 per share in 2026. One of our old school OGs, as they call them, is AIPI, which has a 35% yield and has paid $1.16 in dividends per share in 2026.
I also know FEPI.
FEPI is the other OG, 25% yield. The difference there is you see the yields are much, 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 much smaller than the crazy
But these
ones.
are much, 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 much more reliable and less NAV declining.
25% yield, 95 cents in dividends paid per share in 2026. TSLW, 75% yield with $1.13 in dividends paid in 2026. NVDW is a 50% yield with $1.42 paid in dividends per share in 2026. LFGY is another OG. It's paying a 60% yield, has paid $1.37 thus far in 2026 per share. WNTR, which is my way of basically doing the inverse of Bitcoin. WNTR is a 70% yield and has paid $2.68 per share in dividends in 2026. WiMAX, which is a lot like WPay. WPay is basically a index fund of all the round hill single payer stocks. Well, WiMAX is basically the YieldMax version of the index fund. It's giving you 80% yield and it's paid 44 cents in dividends per share in 2026. And I think this might be the OGest of the OG is USOY. I've had this one forever. It gives you a 50% yield and it's paid 31 cents per share in 2026. So those are all of our income, not all of them, but that's a good chunk of our income producers. Those are our paychecks. So we're basically getting a paycheck from them.
Did you skip YBTC?
YBTC, did I?
I don't know.
I did, yeah. YBTC, another way that's my Bitcoin long. That's a 50% yield and it's paid $2.30 per share in 2026. But that's misleading because they had a huge one-off payment at the very beginning of January. It was like $1.60 or something like that.
Wow, nice. It's cool to be in that.
But like what we do with those is we use these for our bill paying, our fun, and then whatever's left we dump into the ones we mentioned before, the ETFs or CEFs or the dividend growth
So I feel
stocks.
like we should clarify the strategy here because we literally just switched over to this methodology because
I've been using it
before,
all along.
yeah, but we weren't actually pulling the money out. We were reinvesting into the better core portfolio that we had before, the dividend growers and the more stable closed-ended funds and whatever. Going forward, though, we're going to be tapping this as income, and anything that's left over that we do not spend is going to actually go back into what we were doing before with building out the more conservative portfolio so that it's more stable in the long run. Because these high income producers, most of them, not all of them, because FEPI and AIPI are actually pretty stable, but most of them are very susceptible to the NAV decline, which means that at some point it is very possible that your initial principal goes completely to zero. And we saw that with the Coney experiment that's still ongoing and has failed at this point. But we're going to run that to fruition to actually see what the hell happens with that because it has gotten really, really, really shitty because I'm actually really curious.
So my philosophy on these income producers is whatever money I put into them, I fully expect to lose from principal.
Right.
My goal is to make sure that I gain more income than the principal loss. The way to do that is to not have the drip on.
Right.
Because every week I get a paycheck. I get a paycheck from YBTC. I take the paycheck and I put it into something else, or I spend it on something else, or I save it for like a rainy day or whatever. But then whatever I got from YBTC is subtracted from what I owe in YBTC. If you approach investing with these specific things like that, like if you put $2,000 into YBTC and you got $100 dividend payout this week, well, then you take the $100 from the $2,000, meaning that you've actually spent $1,900 into YBTC. So your objective is to get that initial investment back to where it's at zero. So anytime you get a payment from YBTC, on the way down, even after like years, like you're still getting 20 or 30 cents per share. That's actually, then it's just all profit. Then you literally can do whatever you want with it. Just don't drip them. And I've had this discussion with a couple people via talking to them and a couple people on the interweb. You don't drip them. You don't, because all that does is it compounds your problem, because like they're going to go down. Now there are better ones that may prolong the going down, but I think the way they're structured is they all go down at some point to penny stock land. You want to make sure that you've pulled out your initial investment, plus you've got a pretty good amount of income.
I think we should say caveat. Some of them, like the Roundhills, do have underlying shares of the actual assets they're doing the options trading on. I don't think they've been out long enough to actually see what happens with those, if they stabilize at a certain baseline or not.
Well, I think if I look at the other ones, what happens is if they say you have one that invests in crypto companies, but they're still paying a large return of capital, what they're going to do is they're going to liquidate some of the shares in the crypto companies to afford the dividend. So they're like, ultimately it's going to go to zero.
They will too, if they can't afford their promised dividend.
Even with the underlying stocks in play, they're still, because their yield is so high and they're paying out so much in return on capital. What that means is like if they have, say, $20 million in assets and they're only generating, say, $1 million, but they're paying out $2 million. So they're paying
the money has to come from somewhere.
They're paying out $1 million more than they have. They're going to liquidate $1 million worth of their assets under management, thus taking their $20 million down to $19 million so they can afford all the yield, all the payouts.
I mean, the other strategy could just be, because these are risky and we don't entirely know if we will get our initial back before. I mean, he's done it a couple of times, but we haven't had the amount of money in that we have now. So it kind of is like a risk, and not everybody's willing to take that risk. But you could just take that capital, live off that capital while your other portfolios are compounding.
That's what we're doing right now.
But I'm saying you wouldn't necessarily have to have it invested.
I just finished the January dividend totals in the two accounts. On our income portfolio, we had about $2,050 that if we were traveling, we'd be using that for gas and groceries and experiences and buying new toys and shit like that. In our other part of the portfolio, we got $1,800 in dividends back that were reinvested into all the good quality stocks. So the way we've set it up, I think I should like write about it or like teach about it. Like we literally have set up a two-pronged attack where we have 4 times the amount of money in this main portfolio that's actually compounding and growing. And then we have what is that?
1 to 5, 1 to 5,
20% of it about in income fund that just basically just pays us to have fun. So when this dries up or this gets down to the point where it's only like $800 or $500 or something like that, we then can like start strategically turning the drips off over here in the main fund, funneling the money back into the fund account without actually touching the principal in the main one, and still riding these all the way to zero. And then at some point I know that I'm going to have to basically have this as no income, and I'm going to have the other 80% generating.
So I actually wonder if what we've essentially created is kind of like a deferred portfolio tapping strategy. I'll have to think about that.
I don't know what to call it. Anyway, so if you're interested in the income first portfolio, the first step into actually developing one is you basically have to define your income goals and your time horizon.
That's step 1 for pretty much everything.
This requires shifting your focus from total capital appreciation, price growth, to the specific amount of cash flow required to meet your expenses. The first thing I would do is define your why and specific income needs. Why do you need $2,000 a month? Or do you need more than $2,000? But why do you need it? If you can tie meaning into that why, it'll be a lot easier to like feel content and fulfilled versus like still longing for higher income. So before you select the assets, you must determine exactly how much income you need the portfolio to generate. And then you need to make sure that you actually don't do the yield hunting. So like be conservative about it. If you need $2,000 a month, make sure you're getting $2,000 a month out of like quality stuff
at your baseline.
Or you're getting, say, to like what we have going on now, we're getting like half of our dividends are in quality stuff and the other half are in shit. So you would actually calculate the gap. So you basically, you have a good estimate of what you actually need to live per year on your expenses. And then you would subtract any guaranteed monies like Social Security, pensions, child support, whatever you have coming in that's guaranteed income. You subtract that from what you need to live off of. The remaining amount is your target yield goal.
Mm-hmm.
So then you would actually have to establish a time frame. What I mean by that is you basically how many years do I need this income money? If you need it instantaneously, well, that would be your number. It would be, I need it now. But if you need
if you need it now, you should probably get a job while you're building this other stuff out.
If you need 20 years from now, that actually will change the philosophy of your income first portfolio immensely.
Oh, I take that back. Because if you have a lump sum and you can actually reallocate it, you could have potentially your now.
Yeah, income first strategies for immediate needs will differ significantly from those for future needs because you'll have time to grow it. You can put it into you can put it into Microsoft, which pays less than 1% because you know it's going to grow its dividend by, I don't know, 100% in like 5 years. They've run their stock pretty well, actually.
Interesting.
Then you'd actually have to change your mindset to actually adopt an investment mindset. Treat your portfolio like a business where the primary product is surplus cash flow rather than speculative gain.
Right.
That's a complete different philosophy and thinking.
Everybody that we have had switch over to this dividend thing is always still looking at that portfolio value. And it's like getting them to realize you're focused more on your actual dividend payouts and the increase in shares. It's so hard to like get people to like change that mindset because it's been so pounded into us about the value.
Well, yeah, look, we do have what is that called? It's called anchor point bias.
Yes, that too.
Well, I'm just saying that's what we're basically taught that from like 3 years old, anchor bias. So like it's very difficult to snap that.
Well, I think we also like don't see a lot of the fluctuations in our currency because it's all behind the scenes. So we equate money in a portfolio with like tangible items, and like that goes back to that monkey strategy where if you give two bananas to a monkey and you take one away, you feel like you're actually having something taken away from you. I don't know if that's the same as anchor bias, but I think it is. So it's like we're actually mixing two things that really aren't the same thing, but it's hitting us the same psychologically.
What I mean by anchor bias is if you put $100,000 in your portfolio,
you want to stay at 100,000, right? Like if you buy a house for 100,000, you don't want to sell your house for less than 100,000.
That's what I mean by anchor bias.
Yeah. Well, I think that is a technical definition.
So if you've established a time frame and you've actually came up with like how much money you need for your for each month in income, and you've actually changed your mind, okay, I'm more worried about income now than I am about gain, then you need to actually assess your risk capacity in 2026. Once your goals are set, you have to evaluate your emotional and financial capacity for risk. Income stability versus price volatility. That basically what that means is when you know that you're going to receive steady dividends, but the underlying value of your investments may still fluctuate. So like as long as you're able to look at your account and say, I got $1,500 in dividends last month, even though my portfolio went down $1,200, I'm okay with that because I got $1,500 in dividends.
Right. And a good example of this was if you guys watched for the whole last year before we got the proceeds of the condo, we basically were sitting at 100,000 in our portfolio for the entire freaking like 2-year period, even though our dividends were slowly climbing up. It is crazy how like the value just sat where it was sitting.
So now if you're able to actually look at a portfolio and say, it doesn't matter what the principal amount is, I'm cool with the dividend payouts, then you have to this is when you actually start applying the macro trends. Like in 2026, we know that there's going to be interest rate cuts. We know that. We know there's going to be volatility because Agent Orange can't stop talking. So this is when you'll actually start considering current economic factors and basically thinking about inflation, thinking about interest rates, all this stuff, which actually will affect different yields and different investments like BDCs and REITs and bonds differently. So then you actually, if you know the macro trends, you can actually start to create a income stream portfolio that actually accounts for the macro trends.
Right. The other thing that I think needs to be readdressed here is the time horizon aspect. If you have a really short time horizon, your chances of increasing the emotional depravity thing you got going on is going to heighten your risk issues. So just keep that in mind. The longer you can push things out, because we talked at the very beginning of this episode that if you need your money in a very short amount of time and the market doesn't do what you wanted it to do, you're forced to liquidate at a lower quantity because you're like desperate for said cash payout. If you can prevent that need for that through external like job hustling or something else just to get through market swings, like plan a backup plan. I think actually having a backup plan reduces risk a lot too.
Well, like I'm blessed in that I always have a backup plan.
And a backup plan, do a backup plan.
And the backup plan in the portfolio, so I don't have to worry about anything
And
else.
the backup plan of the backup plan.
You're gonna have to master your cash flow habits. So a successful income portfolio relies on strong fundamental habits, foundational habits before capital is deployed. By that, you have to audit your expenses. This is the boring shit where you have to do your budget. Like, okay, what subscriptions do I have? What am I spending on food? Can I tweak any of that so I can plug these cash flow leaks? We've talked about this ad nauseum through the years. Like, I can't even stress enough. Like, we just did this.
This is people's biggest
We just
problem.
did this last week where the average American has $100 in subscriptions, and they're only using 70% of it. So there's 30% of their subscriptions they don't even know they have them, and they're still paying for them. That's a pretty healthy number.
Mm-hmm. And that's not just there. I bet you there's stuff other places.
Oh, there's other stuff like
right?
the coffee. Like, I mean, we keep bringing it up. It's not that I'm because I'm anti-coffee, even though I am. It's just like
it just seems to be the one that most people have.
If it's something that you do every day, and rather than buy a coffee pot, put it in a thermos, which is vastly cheaper than going to get coffee. That's another cash flow leak, because every day you're putting this in. Or I say when you're at work, you go out to lunch every day. That's another cash flow leak. Now, I know we have a difference of opinion on this, because I think that you can plug most of the cash flow leaks. She's more along, if you're not aligned, you're going to it's going to leak out.
They're just going to leak out. You're going to literally have whiplash effect. 1000%. I experience it all the time. I see you experience it all the time. You can't out willpower something when your body is telling you, I absolutely have to have this thing. It's just, that's not how it works. And we're literally creating a whole new podcast here in like the next couple of weeks. I finally have the full framework built out. We're going to launch it, and it's going to be all about that type of stuff to get you realigned and rewired so that saving, budgeting, and all of this stuff is naturally a byproduct without having to consciously think about doing it. Because that's the part that drives me crazy. I'm like real disciplined for a short amount of time, and then like I get bored and I move on to something else, and then I get like I'm not tracking and auditing. But in all honesty, the way that we live, it kind of happens naturally. Like I was trying to force like a really, I think I talked about it on the podcast with having multiple bank accounts and having stuff flow here to pay for credit cards and da-da-da. It's just too complex. Like honestly, the fact that I have to continuously come back with touch points, it's actually creating like stress and anxiety for me instead of just having one account that naturally has an overflow and then just like letting the auto payments happen. If I'm micromanaging it, like I for me, it actually backfires. It's kind of crazy. You'd think it'd be the other way around, but it actually backfires for me. Really?
Now, this next point is one that the readings sometimes agree with me and sometimes they don't. Like, whatever the case may be, whether you do it before you invest or you do it after you invest, they all have the same point. You have to establish an emergency fund which covers 3 to 6 months of your expenses so that you're never forced to sell income-generating assets during a market downturn. I prefer to have the emergency fund established before I even start investing. That way, there's no like temptation to sell anything.
Right. There's no desperate emotional crazy moves.
Whereas I've seen like a lot of the stuff I read, like they say you can actually build up the emergency fund while you're investing rather than put 100% into your investing. You put 50% and 50%. I mean, however works for you.
I was going to say, I think it's dependent on the person.
Just know that you need to have an emergency fund. And I think that 3 to 6 months is actually low. I think that it actually should be more 6 to 12 months.
I think it should be whatever you feel comfortable with. Because again, some people are okay with having like $500 left in their checking account. I do not like having less than $3,000. Like for whatever reason, there's like, we all have our psychological like thresholds.
That's your anchor.
And your anchor bias here is, what'd you say, 12 months of freaking income saved up in an emergency fund?
Well, it's because like I get it. I want to do what I want to do, and
right.
I don't want money to complicate that. So if I have 12 months worth of emergency, then right. I can do what I want without any repercussions.
You could literally have one of those like 50-year storms where everything goes wrong for the whole year and you still don't have to like sacrifice what you want to do. So again, that's preference. They're saying 3 to 6 minimum. We're choosing 12. Personally, for said reasons, because we do not like to have to say no to something we want to do. So
currently we have 2 years in emergency fund right now, but that obviously was going to change. That's our SBAR and THTA, our cash.
Right.
Okay, so we want to set a SMART goal. Basically, if whatever goal it might be, if you want to generate $2,000 a month in income by the end of 2026, that's a goal. Basically, you have to set goals. Where I differ from the readings is they say like their goals seem kind of difficult to reach, like generate $2,000 a month in passive income by the end of 2026.
That's
like
very concrete.
You're not going to get a lot of wins. Whereas I would like to, if you need that cup of coffee, and your cup of coffee runs you about $40 a week, which would be $160 a month. I think the first goal should be I'm going to pay for my coffee with my passive income.
Right. I think making the small micro steps gives you those little celebrations in between, or those little milestones, which humans actually need. We fail a lot more when we cause too big of a goal and then we can't reach it. Like we actually start thinking, so what's wrong with me? Or like we get that like delayed reward or delayed celebration, which actually de-incentivizes the motivation. It actually like stalls the motivation.
Well, I'm the way I'm built is if I set a goal that's achievable, $200 a month.
You get
once
boost of esteem
once I
when
get
you
the
hit it.
$200 a month, I'm like, oh shit, that's pretty easy. Look how nice it is. Then I go, oh man, I can probably get that to 500, and then I get it to 500. That's how it's always been.
And if you want to do it through something meaningful versus just a dollar mark, like if dollars don't resonate for you as much, like he said, your coffee, do it till you can actually afford your coffee without having to actually take any money out of your paycheck, and then add on your Netflix subscription, and then add on your pet food, and then add on something else. Like you just keep stacking actual meaningful things.
Like the last one that I did was
life.
my bike. I basically worked. And
but that was a one-time purchase. That wasn't like a recurring
But that was
thing.
still a purchase.
Yeah, true.
I worked and I put a money every paycheck into Worthy. And then after I think it was 15 months, I had like $3,000 in Worthy. I had like $5,000 in Worthy. That I was able to withdraw $3,000 and actually buy a really good bike as opposed to a piece of shit bike. I was getting small wins. I think
and you were compounding interest.
I think Worthy's undervalued like a vehicle because that you see it every day. Anytime you go into Worthy, you can just look at your reports and you'll see how much you made
every day
in interest.
That's what I like about Worthy. It's a daily like interest thing.
Whereas like your
really
bank,
nice.
where your bank is every month,
and it's so low.
If you make anything. Whereas your brokerage accounts, like you basically have to wait to the end of the month before they do the tabulation of how much income you made during the month. Whereas Worthy's every day. I have something in Stewart, and Stewart doesn't tell me shit. I only get it once a year. I only know once a year what I made in Stewart.
Yeah.
So
if you need those,
if you need the small wins, you have to. I would set up situations where the small wins are possible, like this,
or visible.
$2,000 a month in passive income by the end of 2026. That seems a bit hard.
Yeah, but that seems reasonable until you actually go to do it. And then, yes, the hardness component. And then that's why people actually fall off with their New Year's resolutions all the time. You're not making them smaller, more tangible, and more actually translatable to reality. That's why I said the coffee, the Netflix, the things that mean something to you. If you can translate them into something that matters, you'll be much likely
I read something.
to have success.
This is completely sidebar.
Here we go.
But it was very interesting. There is a movement in Generation Z, and what's the one after them? Anyway, the movement is what they do is they live super frugal during the week so they can do whatever the fuck they want on the weekend.
Well, that's kind of the whole concept of working during the week and then having off weekends.
No, but we're talking like they're super frugal. Like they don't go out to eat. They don't like do coffee. They take coffee from home. They take the bus or they ride their bike, whatever. So they limit all their expenditures Monday through Friday. So on Saturday and Sunday, they can spend money on whatever the hell they want.
I think that's like very similar to the dieting approach where you have like your cheat day or your cheat meal. It's also, I think it's called like sprinting. They're called sprints.
That's fascinating to me that's actually like a generation.
I'm actually more geared towards the interval sprints as opposed to like a year of freaking depravity and then like having whiplash effects. So like they're preventing that whiplash factor.
It's just very interesting that like, because my generation doesn't.
Whereas you are really stubborn and you can like grind down.
My generation says, okay, I'm going to have this by then.
I make it happen.
And we'll make it
through blunt force and burnout and all that fun stuff.
I'm old.
But no, I've noticed that like I do way better with like interval sprints.
The second one, I'm not too worried about this. This is Carm's area. Is basically you have to identify the tax complications with your investing. You're going to have to choose tax efficient accounts like a Roth IRA.
Simple rule of thumb: if you're planning to retire past 59 and a half, you would or benefit from a Roth IRA or like your tax incentivized.
The problem with Roth is you only put X amount on it, right?
IRAs are the ones that have the lower cap. 401ks have a higher cap unless you start your own business and then there's whatever it is. But you can still do multiples up. Like you can do a 401 and a Roth IRA or an IRA in general. Roth is the one where you pay taxes up front so that you never pay taxes when you pull out.
So those would be better for the growth focus.
Like I said, yeah, growth focus or longer time horizon, those are a lot better because you defer the tax burden and like your money compounds faster because of that. Whereas the regular brokerage account is for people who have the shorter time horizon or your time horizon is less than 59 and a half. years of age until they change that number. That's literally the simple rule of thumb.
The reason you do that is because you want to protect your shit from taxes.
Well, if you can
As best you can.
if you can incentivize, if it makes sense, because I even have a Roth IRA. It's just like as a background, whatever the heck thing. But I'm not planning to do anything with that till way the hell down the road. I don't put a ton of money in it. It just is what it is. And those are really good for the growth stock. So we have like SoFi and a couple other things, I think, in that because they're just like long haul, do not care. But your dividends get taxed every time you get paid them versus growth stocks are deferred until you sell. So it's like there's two different strategies happening with the tax wrapper thing. And again, we can do an episode on that, or I think we have done an episode on that, but we could revisit that. So that's another thing to factor consideration in. If you're making it automatic and your employer does contributions of matching, always go with that 100% match because you're getting 100% free money for that, regardless of what's available, even if it's not what you want. I would consider that just like an added bonus.
So, okay, then the last thing I would mention is then you have to determine how you're going to manage the stuff. Are you going to do individual trading yourself? Or are you going to do like a broad-based income ETFs or robo-advisor? I know Schwab, you can just go in there and say robo-advisor.
Right. And this is why a lot of people do default to the index funds because it's literally a set it and forget it. So if you want a set it and forget it, but you like the dividends, go with the dividend growers. It's really that simple. And then
once you have all that established, then you're actually ready to start investing. You have your emergency fund set up. You have like what account you're gonna how you're gonna invest in a Roth as opposed to a regular brokerage account. Then you're able to like actually start investing in securities.
Right, and you can always mix and match.
We've been talking forever now about like good possibilities to invest in. So like if you listen to any of the podcasts. Or I do have a weekly email that actually gives you 10 ideas for the following week.
Right.
And we actually have a live stream, and we do that live stream now every week where it gives you an idea, like
it shows you how we build
constructing the list for the email. So if you don't want to subscribe to the email, just watch this the live stream at your leisure, and that'll give you like the 10 good ideas for getting into for next week. The reason we do that is because if they go ex-dividend next week, if you get into them before they go ex-dividend, you've already started your compounding.
You get your payouts like in the next week.
And so you've already started your compounding
journey. So you got a really quick and easy win.
And for generally speaking, that list is undervalued significantly.
Mm-hmm.
I that's something that I'll continue to do even when
we do it because it helps us find stuff we don't know about, and it also helps us keep the valuation pulse on what's in our portfolio. So it helps us turn drip off when they're high and then turn it back on when they're low, or if we've gotten out of something, it helps us remind us to get back in. Like PDI was a good example. It popped up on the list. We got out of that a while when bond funds surged up, and we took like 30% gain or something on bond fund, which is insane. And then we actually got back into it, and didn't you say it just like surged up again?
It was 30%. Not total return was over 60.
Okay, so there you go. Like that's insane for a freaking bond fund.
That was just price appreciation. It was like 33% price appreciation, and we just got into PDI again. It's one of the ones I mentioned before closing the fund. Basically, it's probably 20% undervalued right now, and it pays you 22 cents per share per month.
Right. So the point of that is like if you want to follow us to like have some training wheels while you're starting to learn all this stuff. We highly our goal is so that everybody learns this stuff for themselves because we don't want to tell you what to do because everybody has a very unique situation that they should apply their own stuff to. Because like with those retirement funds and stuff, like you can have one or you can have none or you can have both of them or you can have whatever, do something completely different. It just really depends on your situation.
And another reason that I do the weekly list is so people can see that what I see when I do Reddit and I do Quora and I do these other online things, people are literally just navigating towards like the 100% yields, and that's not the way. That's
highest yield isn't always best product.
That's not sustainable for your money. Now, can you make money doing it? Absolutely. There's people that make money where they just trade, like they'll say they get into PLTW because it just had a really shitty like couple of weeks. They'll get into PLTW, they'll make some price appreciation, and then they'll sell it. So they're making money, but like, that's to me, it's like day trading, and that's
fine if that's your strategy.
I don't want to do that.
That works and that's the thing because people ask us all the time, why don't we option trade instead of doing the yield max and the Brownhill and stuff? And I've done a really deep dive into it, and I personally think it's a higher risk and way more bandwidth requirement, and I just would prefer to do it the other way. That's us because I've done day trading, and I don't want to be glued to a screen. And when you're in types of stuff that you're planning to flip like that, like you feel the compulsion to watch it constantly and you're not really living. And that's kind of like, we want to live. We don't want to be stalking our portfolios.
So we have one more podcast before we
flip over to the new podcast,
switch our focus.
which we are going to announce in the next episode.
The last podcast is basically going to be in 2026. What is the average American's relationship with money? It's kind of like a prelude into like what we're going to be talking about, like the.
And I will say we're not dissolving roaming returns completely. We're going to still be posting our portfolio updates, our quarterly updates, our whoopsie daisies, and like our predictions, and maybe a couple other odds
macro
and
trends.
ends. And then
macro trends.
we'll be updating our actual expenses each month.
So every month what we'll do is like this was my vision all along. Once this was all the precursor to us starting to travel, and now that we've created an account where we can travel on, so now what we'll be doing is at the end of each month we'll actually be okay. Here's how much we made in dividends this month to the penny. Full transparency.
This is what we spent
here's
money
how much
on.
we spent this month. Here's what we had left, or this is how much we overspent by. So it'll be full transparency. Because I think, to me, I wanted this always to be about the journey going from zero to doing what you want to with dividends. And then once we got to where we're doing what we want with dividends, I wanted to be fully transparent. Like, here's how much we're making, and here's how much we're spending, so that
you can see us living.
You can live through us vicariously, or you can maybe model your stuff after us. If you're interested in it, you can model your portfolio after our portfolio. That's why we'll be doing the portfolio updates every quarter. That's why we'll be doing the budget, like the budget, for lack of a better word, at the end of each month. And that's why we'll be doing the whoopsie daisy still, and the macro trends. I'll still be doing those because that's super important to identify what's going to happen the following year.
Right. And we'll tell you like when our strategy shifts based on stuff. So it's like you won't be left in the dark with things. We just will have less of the heavier intensive like episodes.
Because we have 140.
This will be 143.
143 episodes of all the precursor stuff. Now I want to have 143 episodes of having fun.
And I'm probably also going to have Tim write a book on this whole thing to actually, like, if you like our investing strategy, you can learn it step by step through the whole thing. So we will actually put out stuff for that. But when we pivot over this other thing, so technically we'll have 2 podcasts going.
So that's it for this one. Next week, again, will be the current relationship with money, and there will actually be a live stream at some point next week, Tuesday. Generally, we do it on Tuesday. Sometimes the time fluctuates based on what we're doing, but Tuesday there'll be a live stream constructing the latest ex-dividend list.
And if you want a specific stock evaluated, just either show up on the live stream and drop it in the chat, or if you miss it, just literally comment on the last live stream.
Yeah, comment on this.
We will actually analyze it.
I answer the comments when they come in, and if you want, I mean, I'm sure there's.
We don't have anywhere to put comments on these. I have to fix that later.
I'm sure there's an email tag somewhere if you have a.
Yeah, you could always email Tim in the show notes. But if you do have a ticker you want us to evaluate during a live stream, you can always put it in the actual comments of the last one, and we'll do it in the very beginning of the next one that we do. So we'll do that going forward. Or we've been doing that. But we haven't had a lot of people stalking us. So that's on you guys if you want to use the resource. If not, we're going to continue to do it because it helps us invest.
They watch, so maybe
whatever.
They're just shy.
It's very possible. Everybody's shy about money. But we're going to continue to do that because it helps us.
This here, in case you guys don't know, this is my Babello. It's my hydrogen. Like, basically, it creates its own fizz, so I don't have to drink pop.
We've talked about Bobo.
And I emailed them last week. I was like, hey, I'm going to be training for a bike race. And they were like, oh, okay. Well, we probably could collaborate there. Can you send us some videos, some content of what you're doing? I was like, well, I have to wait till I get balls deep into training. But yeah, I will totally send them. If you haven't drank Bobello, I would highly recommend it. If you want to.
They have it available at
Sprouts.
What the hell is Sprouts?
It's a grocery store.
I thought they had it at Costco and stuff now.
They have a Costco too.
Okay.
Costco and Sprouts. What it basically is if you don't want to quit pop or soda or whatever the hell you want to call it, Coke, there's a hint of fizz to it, and it comes in basically.
It's actually healthy compared to soda. It has sweetness, and it has a lot of vitamins and minerals in it. So.
And amino acids, a couple of amino acids.
Right. So it's
and
a lot healthier.
I can't live without it. So.
He's addicted. So that's his coffee. That's why I give him shit about making fun of people with coffee, because this is basically the same thing for him.
But the difference is,
yeah.
One bag of this costs $30, so you're only spending $1 a day.
Okay. Well, maybe they're only spending $1 a day.
No, probably if they're doing the coffee at home.
All right.
Well, see you guys next week. Hope you like this. Income first. I'm a huge proponent of income first portfolios as opposed to the growth portfolios. That's just my personal opinion. A lot of people don't like it, but a lot of people are all focused on growth.
Do what works for you. We'll see you next week.
See you next week.